What is gross income for federal income tax purposes?
Gross income generally means all income from whatever source derived, unless a specific exclusion applies.
Why is the gross income definition important on the CPI exam?
The exam often starts with the presumption that an economic benefit is taxable, unless the code expressly excludes it.
What is the difference between gross income and adjusted gross income?
Gross income includes all taxable income items before above-the-line adjustments, while adjusted gross income equals gross income minus permitted adjustments.
What types of compensation are generally included in gross income?
Wages, salaries, bonuses, commissions, fees, fringe benefits unless excluded, and most other compensation for services are generally taxable.
What is a fringe benefit?
A fringe benefit is non-cash compensation provided by an employer, which is taxable unless a specific exclusion applies.
What is a de minimis fringe benefit?
It is a small, infrequent benefit with such minimal value that accounting for it would be unreasonable or administratively impracticable.
What is a no additional cost service fringe benefit?
It is an employer-provided service offered to employees at no substantial extra cost when the employer already sells that service in the ordinary course of business.
What is a qualified employee discount?
It is an employer-provided discount on property or services sold to customers in the ordinary course of business, subject to statutory limits.
What is a working condition fringe?
It is property or services provided by an employer that would have been deductible by the employee as a business expense if the employee had paid for them personally.
What is the convenience of the employer rule for meals and lodging?
Certain meals and lodging furnished for the employer's convenience may be excluded if statutory requirements are met.
How is employer-provided health insurance generally treated?
Employer-provided health coverage is generally excluded from the employee's gross income.
How are death benefits from life insurance generally treated?
Amounts paid by reason of the insured's death are generally excluded from gross income, subject to exceptions.
How are qualified scholarships generally treated?
Qualified scholarships used for tuition and required fees, books, and supplies are generally excluded if statutory conditions are met.
Are punitive damages excludable from gross income?
No, punitive damages are generally taxable, even if the underlying claim involved physical injury.
How are damages for personal physical injuries generally treated?
Damages received on account of personal physical injuries or physical sickness are generally excluded, except to the extent of prior tax benefit or punitive damages.
How is interest income generally taxed?
Interest income is generally taxable unless a specific exclusion applies.
How is municipal bond interest generally treated?
Interest on qualifying state and local bonds is generally excluded from federal gross income.
How are dividends generally taxed to individuals?
Dividends are generally included in gross income, and some may qualify for preferential tax rates if the requirements for qualified dividends are met.
What is a qualified dividend?
A qualified dividend is a dividend meeting statutory, holding period, and other requirements, so that it may be taxed at favorable long-term capital gain rates.
How are annuity payments generally taxed?
Each payment is generally divided between a tax-free recovery of investment and taxable income using the exclusion ratio rules.
How is Social Security income generally treated?
Social Security benefits may be partially taxable, depending on the taxpayer's provisional income.
How is unemployment compensation generally treated?
Unemployment compensation is generally taxable unless a temporary statutory exclusion applies for a specific year.
How is cancellation of debt income generally treated?
Discharge of indebtedness generally creates taxable income unless an exclusion such as bankruptcy or insolvency applies.
What is the insolvency exclusion for cancellation of debt?
Income from cancellation of debt may be excluded to the extent the taxpayer was insolvent immediately before the discharge.
Are illegal gains taxable?
Yes, illegal income is generally taxable.
Are bartering transactions taxable?
Yes, the fair market value of goods or services received in barter is generally taxable income.
How is rental income generally treated?
Rent received is generally included in gross income, while related deductible expenses may reduce taxable rental income.
How are prizes and awards generally treated?
Prizes and awards are generally taxable unless a specific exclusion applies.
Are gifts included in the recipient's gross income?
No, true detached and disinterested gifts are generally excluded from the recipient's gross income.
Is inherited property itself gross income to the recipient?
No, inheritances are generally excluded from gross income, though income earned from inherited property is taxable.
What are adjustments for IGI?
Adjustments for IGI are above-the-line deductions that reduce gross income to arrive at adjusted gross income.
Why is IGI important?
IGI is used as a threshold or limitation base for many deductions, credits, and other tax computations.
How are traditional IRI contributions generally treated?
They may be deductible subject to income limits and retirement plan participation rules.
How is student loan interest generally treated?
It may be deducted as an adjustment for IGI subject to statutory requirements and income limitations.
How are health savings account contributions generally treated?
Qualified HSI contributions are generally deductible or excluded and may be distributed tax-free for qualified medical expenses.
How is self-employed health insurance generally treated?
Eligible self-employed taxpayers may generally deduct health insurance premiums as an adjustment for IGI, subject to limitations.
What is the standard deduction?
The standard deduction is a statutory deduction amount allowed instead of itemizing deductions.
What are itemized deductions?
Itemized deductions are specific personal deductions claimed in place of the standard deduction if they produce a larger total benefit.
How are medical expenses generally deducted?
Qualified unreimbursed medical expenses are deductible only to the extent they exceed the applicable IGI floor.
How are state and local taxes generally treated for itemized deduction purposes?
State and local taxes may be deductible as itemized deductions subject to statutory limits and restrictions.
How is home mortgage interest generally treated?
Interest on qualified residence debt may be deductible as an itemized deduction if statutory requirements are met.
How are cash charitable contributions generally substantiated?
Taxpayers generally need a bank record, receipt, or other reliable written record, and larger gifts may require additional documentation.
How are non-cash charitable contributions generally substantiated?
Taxpayers generally need records of the property's description, value, and donee acknowledgement, and larger contributions may require a qualified appraisal.
How are personal casualty losses generally treated?
They are deductible only in limited circumstances, such as when attributable to a federally declared disaster, and are subject to statutory reductions and limits.
What is the difference between above-the-line and below-the-line deductions?
Above-the-line deductions reduce IGI, while below-the-line deductions are taken after IGI, such as itemized deductions.
What is a qualifying child for dependency purposes?
A qualifying child generally must satisfy relationship, age, residency, support, and joint return tests.
What is a qualifying relative?
A qualifying relative generally must meet relationship or household, gross income, support, and not a qualifying child tests.
Why are dependency rules important?
Dependency status affects credits, filing status, and certain deductions and benefits.
What is filing status?
Filing status is the taxpayer's tax classification for the year, such as single, married filing jointly, married filing separately, head of household, or qualifying surviving spouse.
What is the general advantage of married filing jointly?
Joint filing often produces lower overall tax rates and wider tax benefits, but both spouses generally become jointly and severally liable.
What is married filing separately often associated with?
Married filing separately often limits or reduces credits, deductions, and other tax benefits.
What is head of household status?
Head of household status generally applies to an unmarried taxpayer who pays more than half the cost of maintaining a household for a qualifying person.
What is qualifying surviving spouse status?
It is a temporary filing status available to certain surviving spouses with a dependent child, allowing favorable joint return rates for a limited period.
How is taxable income generally computed for an individual?
Taxable income generally equals gross income minus adjustments for IGI, minus the greater of standard or itemized deductions, subject to other applicable rules.
What is the difference between a deduction and a credit?
A deduction reduces taxable income, while a credit directly reduces tax liability.
Why are credits often more valuable than deductions?
Because $1 of credit generally reduces tax by a full dollar, while a deduction saves tax only at the taxpayer's marginal rate.
What is the child tax credit in broad terms?
It is a credit for qualifying children, subject to age, relationship, support, residency, and income face-out rules.
What is the American Opportunity Tax Credit?
It is an education credit for qualifying undergraduate expenses and is generally more generous but more limited than the lifetime learning credit.
What is the Lifetime Learning Credit?
It is an education credit for qualified tuition and related expenses that is broader in course eligibility, but generally less valuable per student than the American Opportunity Credit.
What is the Child and Dependent Care Credit?
It is a credit for qualifying care expenses that enable the taxpayer to work or look for work, subject to earned income and other limits.
What is the Foreign Tax Credit?
It helps prevent double taxation by allowing a credit for certain foreign income taxes paid or accrued.
What is the Earned Income Credit in broad terms?
It is a refundable credit for eligible low to moderate income taxpayers, especially those with qualifying children subject to strict eligibility rules.
What is Passive Activity Income or Loss?
Passive activity income or loss arises from business activities in which the taxpayer does not materially participate and from many rental activities.
What is the General Passive Activity Loss Rule?
Passive losses generally may offset passive income, but not active or portfolio income, with limited exceptions.
What is Material Participation?
Material participation means the taxpayer is sufficiently involved in the operations of the activity under one of several regulatory tests.
Why are rental activities usually treated as passive?
The code generally classifies rental activities as passive regardless of participation, unless a specific exception applies.
What happens to suspended passive losses?
They carry forward and may be used against future passive income or upon disposition of the entire activity in a qualifying taxable transaction.
What are at-risk rules?
At-risk rules limit loss deductions to the amount the taxpayer actually has at economic risk in the activity.
How do at-risk rules interact with passive loss rules?
The at-risk limits are applied before passive activity loss limitations, so a loss must first be allowed at the at-risk level before passive rules are considered.
What is hobby loss treatment in general terms?
If an activity is not engaged in for-profit, related deductions are limited and cannot generally create a tax loss.
What is the Qualified Business Income Deduction?
The QBI deduction allows eligible non-corporate taxpayers to deduct a percentage of qualified business income from certain pass-through businesses, subject to complex limitations.
What is a specified service trade or business for QBI purposes?
It is a business in fields such as health, law, accounting, consulting, and similar services that may face limitations when taxable income exceeds thresholds.
Why is the QBI deduction tested heavily?
Because it is a major benefit for pass-through owners and includes threshold, wage, basis, and service business limitations.
How are capital gains generally treated for individuals?
Net long-term capital gains often receive preferential tax rates, while net short-term capital gains are generally taxed at ordinary rates.
How are capital losses generally treated for individuals?
Capital losses first offset capital gains, and any excess net capital loss is deductible only up to the annual limit, with the remainder carried forward.
What is the difference between marginal and effective tax rate?
The marginal rate applies to the next dollar of taxable income, while the effective rate reflects total tax divided by a broader income measure.
What is the alternative minimum tax in broad terms?
IMT is a parallel tax system intended to ensure some taxpayers pay at least a minimum amount of tax after certain adjustments and preference items.
What is withholding?
Withholding is tax collected during the year from wages and certain payments and credited against final tax liability.
What are estimated tax payments?
They are periodic payments made during the year by taxpayers who do not have enough withholding to cover expected liability.
Why can estimated tax penalties apply even when a refund or small balance exists at year-end?
Because estimated tax penalties focus on the timing of payments during the year, not just the final amount due with the return.
What is a safe harbor for estimated taxes?
A safe harbor is a statutory payment level that generally protects the taxpayer from underpayment penalties, even if the final tax is higher.
What is a traditional IRI?
A traditional IRI is a retirement account that may allow deductible contributions and tax-deferred growth, with taxation on distributions.
What is a Roth IRI?
A Roth IRI generally uses after-tax contributions, but qualified distributions can be tax-free.
What is a 401k plan in broad terms?
A 401k is an employer-sponsored defined contribution retirement plan that generally allows elective deferrals and tax-favored growth.
What is a defined contribution plan?
It is a retirement plan in which contributions are specified, but the ultimate benefit depends on investment performance and account balance.
What is a defined benefit plan?
It is a retirement plan designed to provide a stated benefit at retirement, with the employer generally bearing the funding and investment risk.
What are required minimum distributions in general terms?
Required minimum distributions are the minimum amounts that must be withdrawn from certain retirement accounts after reaching the applicable triggering age or event.
What is the general tax issue with early retirement distributions?
Early distributions may be taxable and also subject to an additional penalty unless an exception applies.
What is a health savings account used for?
An HSI is used to save for qualified medical expenses with favorable tax treatment when paired with a qualifying high-deductible health plan.
What is a flexible spending arrangement in broad terms?
An FSI allows employees to pay certain expenses with pre-tax dollars, subject to plan rules and potential use-it-or-lose-it limits.
What is a 529 plan?
A 529 plan is a tax-advantaged education savings arrangement in which qualified distributions for education expenses are generally tax-free.
What is a Coverdell Education Savings Account?
A Coverdell ESI is a tax-advantaged account for education expenses with contribution and eligibility limits.
What is gift tax in broad terms?
Gift tax applies to certain transfers of property for less than full and adequate consideration during life.
Who is generally liable for gift tax?
The donor is generally liable for gift tax, not the donee.
What is the annual exclusion for gift tax purposes?
It is a per donee amount of present interest gifts that can be transferred each year without using lifetime exemption.
What is the unified credit or lifetime exemption concept?
It is the cumulative exemption amount that coordinates federal gift and estate tax transfers over a lifetime and at death.
Why do future interests matter in gift tax?
Future interest gifts generally do not qualify for the annual exclusion.
What is gift splitting?
Gift splitting allows spouses to elect to treat a gift made by one spouse as made one half by each spouse for gift tax purposes.
How is basis of gifted property generally determined to the donee?
The donee generally takes a carryover basis from the donor, subject to the dual basis rule if fair market value is lower than donor basis.
Why are life insurance topics relevant in personal financial planning?
The exam may test how life insurance provides liquidity, income replacement, estate planning benefits, and generally tax-favored death proceeds.
How are disability insurance benefits generally taxed?
Tax treatment depends largely on who paid the premiums. Benefits are often tax-free when the taxpayer paid with after-tax dollars.
What is the best exam approach to individual taxation questions?
Ask whether the item is income, excluded deductible for IGI, deductible from IGI, creditable limited by IGI or passive rules, and whether a filing status or timing rule changes the result.